So good afternoon everybody, Stuart here again. So today's webinar is Success in Trading, and it really is just a mind game. This business is very much a game of psychology, and if you understand yourself, you're a long way down the line to being a successful trader. So just before we get going, if there's any questions that I don't answer in the question box during the course of the webinar, just send them to webinars@hotforex.com and I'll get back to you as quickly as I can. Obviously, any problems with the audio or the visuals, either sometimes it can be a problem with your internet at your end, it could be our end. Sometimes restarting GoToWebinar sometimes helps as well. But any problems like that, try that and try restarting your own device as well sometimes. So welcome again. Before we get going, I'll just need to read through our disclaimer. So this disclaimer is material is provided as a general marketing communication for information purposes and does not constitute independent investment research. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purposes of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in CFDs and FX product is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Okay, so that's the admin out of the way. I hope you're all well today. Lots of you in here today, so good session. One of my favourites, very close to my heart, this particular webinar. But who am I? My name's Stuart. I'm in my early 50s. I've worked in the City of London for nearly 20 years. I've been investing and trading my own money since 1997, September 1997. And the four things I've learnt over the years, not that they're right or wrong, it's just what I've learnt and what I've put into practice, we're going to talk about today. So probability, keep it simple. We don't talk about timeframes much today, but that's something I look at as well. But the most important one is that one there, know yourself. And I won't go through that now because we're going to spend some time talking about that, or quite a lot of time talking about that during the webinar. Okay. So again, can I just do a quick heads up of the guys that are in today? What sort of traders we got in here? I mean, presumably you're all here to try and learn something new. You're either new to trading, or you've lost an account and you're looking to move forward a little bit of help with the psychology of trading. So is anybody a complete new trader that we got in today? Anybody not traded at all? No response, so that's good. So everybody's had a little go at all. Okay, so has anybody been trading for more than 3 or 4 years? Or 2 or 3 years? Anybody got more than... Okay, so some of you have been trading a longer time. Okay, so presumably you're looking for a little bit of help and advice about how to stop losing or why things go wrong, I would guess. Alright, Arif, 5 years, okay. So Arif... So you're looking for a new direction, or a bit of my thoughts, hopefully, Arif. Thank you for that. Okay, good. All right, well let's crack on. There are some very simple numbers, some simple psychology that if you stick to, I say you can be successful. So let's get through this today. So today I'll talk about how to win and how to lose, because it's a mind game. It really is a mind game, and that's the heading of this a webinar. Successful trading is simply a mind game. If you understand yourself, understand your risk profile, understand what sort of person you are, and what's the best type of trading that suits you personally, you'll be a long way down the line to being successful. I call it staying afloat in the trading ocean. So it's all about knowing yourself and risk management. My big mantra: risk management, money management, very important. And some simple numbers. Very simple numbers. If you keep applying them, you understand the maths, you'll be amazed at how simple it can be. And too many people complicate this business far too much. So why we lose? Okay, I'm going to run through a few slides here. 3 slides with 4 points on each, so 12 points. I could have written, 20, 50 points because I've done all these things. But these are my top 12, my dirty dozen, I call them. And I've done all these things in a greater or lesser extent. So what I'd like you to do is think about why you're here today and what you want to get out of today and from me, because I'm here for you. Okay, if you're successful, we're successful as a company, because you trade successfully, you win your trade, you take your money out, you tell everybody about what how great it is trading, you got great education, and I can withdraw my money, and I'm a good trader, and you tell your friends, and we all grow together. So that's really what this is all about, and I'm here for you. So, and I've made all these mistakes because I've trading and trade too as well. So let's think about. So when I finish these slides, I want you to be honest with yourself. What's your score? And I say I score 12 out of 12. I'm not proud of it, but that's what happened, and probably 20 out of 20 if I'd added some more. So let's get onto the first slide. So these are not in any particular order, but there's, I say, my top 12. But number 4 there is probably the one I would say was probably the most important. It probably should be number 1. But number 1, too little capital. People don't invest enough to give themselves a chance. Okay, or they don't understand their margin, or they don't understand lot size, or they don't understand leverage, even more basic than what I'm going to talk about today. You've got to understand that, and if you don't invest enough, it's very difficult to make a decent return. So also, don't expect to try and make too much. So the example I've put on there, don't invest $1,000 and try and make 500 within a week, 50% return. That doesn't happen. Well, it does happen, but it's not gonna. If you do that, you probably just got lucky. But if you think you're a good trader and you've done that, the market will come and bite your bum in the end. So don't invest too little. Try and invest as much as you can. That's not going to affect your day-to-day lifestyle. So invest in too little capital. The other thing, don't risk too much. Don't risk 20, 30% each time you open a trade, because that way you can very, very quickly empty your account. Risk 20% of your account on a trade, and you've only got 5 chances to get your trades wrong, and you end up with an empty account. Risk 30% of your account, $30 of your $100 or $300 of your $1,000, and 3 times do that, and your account's empty again. So don't risk too much. It's all about risk management. We'll talk about a lot about that today. Third one is over trading. A killer. It's very easy to slip into. I've done it in the past, and I tend not to do it anymore. But it's something very easy to slip into, because you feel as if you have a few losing trades and you want to get even. You want to get back at the market. You want to try and get your losses back. Trading to get even, it never works. You put too much pressure on yourself. You've got to try and treat each and every trade as an individual, not influenced by the previous trade. Whether you've had 4 or 5 winning trades or 4 or 5 losing trades, you've got to try and take the 6th trade, that next trade, keep it completely independent from the previous trade. It's very difficult to do, and you've got not to, do too much trading. So keep it in perspective. The flip side of that is under trading, which I'll talk about a bit later as well. So the most important one of these 12 for me is not knowing yourself. If you're not psychologically built to be a scalper, and you think that's how you want to trade, you'll end up kidding yourself, because your subconscious, your mind will trip you up. So can you trade 5-minute candles, or are you more suited for trading the end of day candles? Or are you the sort of person that needs the buzz of having lots of interaction, lots of trades very quickly? You don't want to have the risk of keeping a trade open overnight, because you won't be able to sleep. That's what sort of person you are. So you need to close your trades at the end of the day or the end of the week. So it's all about knowing yourself and what sort of person you are, and very much about accepting losing. And I talk about that a lot in these webinars, and knowing yourself is absolutely vital to being a successful trader. And again, as I say, I've made all these mistakes. So they're the first 4. The second 4, I very quickly stopped doing number 5, trading without a stop loss or take profit. I hear all sorts of nonsense, especially about stop losses, that brokers go stop hunting. They know where my stop loss is, and they'll move the price down to that price. just doesn't happen. Brokers are are too busy. There's thousands and hundreds of thousands of trades going through the market all the time. They're not interested in your small little trades. We're very insignificant to the market. You know, trading with a stop loss and a take profit takes a lot of the angst out of it, takes a lot of the stress out of it. And if you know that and I'll talk about this later, but if you know that the stop loss is at a certain, it's under a certain support area or resistance area, and you know that if the price gets there and you lose X amount, and that X amount is only a small percentage of your account, that you should be fine with that, because this business is very much a business, and you've got to treat it like that. You've got to treat it and accept that you will lose. You will have lots of losing trades. And again, we'll see later on that this crazy business, you can get it wrong 50% of the time and still make a very good return on your money. No other business. Think of any other job that you do. I don't know what you guys do out there, but if you're an engineer or an accountant or a pilot or a nurse or a doctor, and you got things wrong 50% of the time, you'd be sacked on the spot, wouldn't you? Or I used to work in telecoms as well, and an internet network that was up 50% of the time is no good. Even 95% of the time is no good. So in this crazy business, you can make a very good return by getting things wrong a lot. The problem is many people can't accept getting things wrong and won't accept losing. And I've put on there number 6, 60% win rate is not enough for some people. Well, 60% win rate is a very good win rate, and if you use the right risk management, you can make a very good return on it. So it's all about trading with stop loss, taking with a top take profit, takes the pressure away, and accepting yourself and accepting that you will lose, and it's part of the business. It's just what you do. No trading plan. Many people jump into this business and think, I just want to make money. That's all I want to do. That's all I'm interested in. And how am I going to do it? Well, don't write anything down. Have no plan. No targets. We all need targets in life. And when I started, I did exactly the same thing. I had quite a big chunk of capital. I'd got lucky by buying some shares, and I thought I knew what I was doing, but I didn't really have a trading plan. And when I started trading more often, it suddenly started catching up on me. So write a trading plan. There's lots of them out there. I've seen them either up a page, which is probably a little bit too thin. 2 or 3 pages is quite good for a trading planner. I've seen them as long as 10 pages. For me, that's too complicated. But make sure you have a trading plan on why you're doing this. Just to make money isn't good enough. Ask yourself again. Look yourself in the mirror and say, why am I doing this? Do I want to, do I want to buy some land? Do I want to buy a house? Do I want to send my kids to university? Do I want to go to university? Do I want to pay off my debts? Have a target, have a plan, and write it down. Writing it down, again, not physically keying it into a computer, but writing it down with a pen and paper actually sort of cements it in your subconscious much more so than keying it into a computer or keying it into a Word spreadsheet. So, write it down, stick it next to your trading terminal. This is my plan. This is how I'm going to execute it. And again, something I didn't do when I first started. 8 is really important. This business is a marathon. It's not a 100-meter sprint race. It's a marathon. The markets have been doing what they've been doing for hundreds of years, and they will keep doing what they've been doing long after I'm gone, because the markets are what they are. They go up, they go down, they go sideways. Whatever asset you're trading, whether it's gold or oil, pound against the dollar, whatever it is, the South African rand against the US dollar, whatever it is, it goes up, it goes down, it goes sideways, and you need patience and discipline. And that all comes back to knowing yourself again. So what sort of person are you? Again, I can't tell you that. You've got to really look at yourself in that mirror and say to yourself, am I cut out for doing this? Most people are cut out for doing this, but you've got to know yourself and not try and do something that doesn't fit with your psychology, your build up, your physiology as well. Okay, final 4 I should say, top 12. Poor timing. If only I'd bought it then, if I'd owned it, that just happens, and that comes with practice and training, and that's something you can learn. Okay, getting in at the wrong time or reacting to the news at the wrong time, that's something that does come with experience. Not giving your system long enough. I've seen many traders They go through all the first steps about knowing themselves and not risking too much, but giving up too quickly because they don't give their system long enough. Even the ones that don't risk very much, they sort of give up because they lose heart, because they have sometimes statistically, remember, you need you would need at least 100 trades to give it any sort of evidence-based sort of feedback for yourself. So don't give up after 10 or 20 trades, because out of those 10 or 20 trades, you've got to have all your losing trades. It's possible but unlikely. If you understand anything about statistics, you could have had all your losing trades in those first 10 or 20 trades for the next 50 trades. So write it all down, make some records. I know everybody says now, well, my broker logs everything, and the MT4 platform's great. It shows me the trades that are open, my profit and loss, and closed trades, and my swap costs and all that sort of thing. But if you write stuff down, again, like I said about writing a trading plan, why you get into a trade. It's all about trading journal and having a record. And then you start to understand yourself, because you start to see a pattern forming. Especially when you start to do 50, 100 trades, you start to see, oh, look at that. Every time I go short, I seem to do better than when I go long. Or every time I trade the British pound against USD cable, I don't do very well, whether I go long or short. And you'll see all these patterns forming. And the time of day when you're trading, all these things will start to come out. And again, it will help you to focus what's the best way, what's the best approach for me. Joel's put in here an example of a trading plan. Well, Joel, there's lots of them out on the website, but again, I don't know why you're trading. If it's just to make money, okay, well, write that down. That's perhaps your first target. But how are you going to do that? How are you going to execute that? And we'll talk about this more later. So have a plan for your trading plan. And again, I'll send you an example of one. Actually, I can email you one. Okay. So, and 12, this final one I've put on here, is that so many people again come into this business and don't understand these three things, the simple numbers. They don't understand the leverage. They don't understand what a pip is. They don't understand the benefits of having a stop loss and a take profit. They don't understand the trade size, the lot size, how quickly that can catch you out if you're you click the wrong trade size. You trade with a full lot when your account really only justifies a micro lot or a mini lot. Honestly, it's as simple as that. Some very, very simple numbers, which I'll talk about in a minute. As I say, I've done all of these things, all 12 of these and more. All these mistakes I have made, and it was only when I stopped, took a big breath, and started to write stuff down, I realised how to move forward. So I don't know. I mean, who scores 12 out of 12? Who's done all these things? If who said they've been trading for 5 years? Full. You said you've been training for 5 years. So I mean, how many of these have you done? How many of these 12 things have you done? As I say, I've got 12 out of 12. I've done all these problems and more. So I'm sure some of you could come up with other examples here. Say I could have quite easily have written 20 reasons of why why I lose, or why I lost, or why we lose. Okay. So there are 3 key criteria you should always focus on, and I talk about this a lot. And I don't apologize for repeating myself, because it's really important for me. You've got to know yourself and understand your belief pattern. Okay. We're all different. So when I say your belief pattern, I mean when you decide to buy something, you have decided in your head that it's going to go up. Okay, so it's a bit like, so that's what's making you tick. If you think it's going to go down, you sell it, don't you? So you've made a decision, you've done your analysis, and that's what your belief pattern is. You're attached to that position. So you've got to understand what makes you tick and understand why you make these decisions. Second one is, for me, Key as well. Well, absolutely key. Risk management. It's absolutely vital for success. And me, for me, it's the most important because if you keep your risk small, you stay in business longer, and that's what it's all about. I've spoken to hundreds of traders over the years, and the two key things that losing traders do, or you see time and time again, is they don't understand about risk and money management, and they risk too much on each trade, or their trade size will be too big for their account size. So you can have, again, I've seen it all the time, you can have lots of small winning trades, but a few huge losers that wipe you out. So you can have 80-90% win rate, but still end up with an empty account because you're not applying risk and money management and using the right trade size. And then on top of that, some people, it slips into this over trade because they just trade everything. They don't think about the probabilities. And it really is all about, if you think something looks probable, I always say do it. If it doesn't feel right or doesn't look right, don't do it. Wait for it. This market is 24 hours a day, 5.5 days a week, and there's always another opportunity coming along. And it really is all in some simple numbers I'm going to talk about in a little while, and especially about the percentages. If you concentrate on the percentages, forget about how big your account size is. If you concentrate on the percentages, that's when you get good. Because if you get your percentages right, your account size, your account can grow. So if you can do this with a $500 or $5,000 account, you can do it with a $50,000 account because the principle is exactly the same. Okay. Right. Somebody's asking me if I could scroll back. I was a bit late. Okay, Blessing. Excuse me, chaps. Let me just scroll back for Blessing. Let's just quickly run through the 5 or the 4 slides. So 12 key things, Blessing. Capital, risk, overtrading, knowing yourself, stop loss, accepting a lose, no trading plan, patience, discipline, poor timing, that's something you can learn, not giving your system long enough, not writing anything down, no records, and not understanding these simple numbers I've just talked about. I've made all those mistakes and more, and if I was honest, I get 12 out of 12. I don't know what you guys get about getting things wrong, but 3 things: know yourself, risk management, do what's probable, all vital. Okay. Next one, knowing yourself. It's all about timing and time frame. So when do you want to trade? Do you want to trade all day? Do you want to sit in front of your screen trading all day? Most of us have jobs to do, or if you're a student, you've got college to attend. If you're retired, you want to spend more of your time doing other things. So fit it in around yourself. Trade when you can, not always when you want to. Also, if you're trading during the day, be aware of the changeovers in the session. So particularly as Europe wakes up, Asia's going to sleep, and certain currency pairs like the pound yen can be particularly volatile at this changeover time. The Aussie can be start to slow down a bit at that morning as London wakes up and Europe starts kicking into it. And same in the afternoon as America wakes up, the American traders get to their desk, North America comes to life. The dollar typically starts to get a bit more spiky, or we start to see a bit more volatility because there's more liquidity in the market. So always be aware of what's going on and what the time frames are, but make it fit around your lifestyle. So when do you want to trade and when you can trade? Can you trade 2 or 3 times a day? Can you get to the screen, or can you? Is it not possible because you're out all the time? So once a day. And when would that be? Would it be before you went to work, before you after work? So fit it in. And if it's once a day, look at the end. Just look at the daily candles. There's plenty of opportunities on those daily candles as well. So fit it in around you, because it's all about you. The markets don't know what you're like. They don't care what you're like. They don't care where your take profit is or your stop loss is. They don't know. They don't mind. It just, it goes up, it goes down, it goes sideways, and that's all it's do. So you have got to understand you. It's you, not against the market, but the market is what it is. It just does what it does, and you just got to accept that. Many people say to me, well, Stuart, that news that's just come out, that should have been great for the dollar, but the dollar's gone down. Why? Well, I don't know why. It just has. That's what it's done. the market isn't logical. It's not like any other job you've done either. That's the other thing about trading. Um, some people are sometimes psychologically better designed to be traders because they can accept risk more. Women tend to be very good traders. There's not enough women trading in my view because they can deal with risk better than men. They don't have to win all the time. As men, we want to win all the time. It's just the way we've been built over millennia. We're the head of the tribe. We're the head of the family. We've got to protect our family, and we've got to go out. So we're very much more risk takers than females. Females in high risk jobs make the best traders. So if you're a female pilot out there, or a female nurse, or a female firefighter, you're doing a job that exposes you to risk all the time. So you deal with risk better, and because you're a female, you deal with it even better. So they tend to make the best traders. Unfortunately, there's not enough women trading in my view, but anyway, that's another story for another day. Not enough women involved in the financial services altogether, but again, that's a story for another day. So it really is all about understanding you. So if you know yourself and you can reduce the emotion, you take the emotion out of it, but you've got to really, again, look yourself in the mirror and be honest. We're all driven by a belief structure, and as traders, we're dominated by our emotions, unfortunately, and the two key emotions are fear and greed. People talk about hope and regret as well, but as a trader I say you shouldn't have any hope or regret in trading, otherwise it's going to catch you out in the long run. And there's three types of fear. There's the fear of making a loss, which makes sense. You open your trade, you risk your money, you lose your money. Oh dear, that's happened. The other two fears are a bit stranger, but the last one could be even more damaging. But the fear of missing a trade. So you think, oh well, I can't get to my screen, this is my setup. Oh, the 4-hour candle is finishing at 12 o'clock. I can't get to the screen. Oh, you get to your screen at 1 o'clock and look, it's triggered and it's done exactly what you thought it was doing. You think, oh God, I should have got that trade. And you start beating yourself up about it. So that's another fear. And then the third one is actually losing a profit, and that can be one of the most damaging of all, because if you're sat in front of your screen, or if you're not in front of your screen and you come back to it and you've seen it, you left your screen and it was nicely in profit, it was nice and black and it was looking good and everything was positive, you went away, you walked the dog, or you went to pick the kids up from school, or you had to go to college, or whatever you had to do, you come back and then all of a sudden it's red and it's gone exactly the opposite way. Oh no. And then it goes on and hits your stop loss. That sometimes can eat away at you. So it's that fear of making a loss, missing a trade, and losing a profit. The other side of the coin, the same coin, is greed. Don't get too greedy, don't get too scared, don't get too fearful. Gordon Gekko said in the famous film of 1987, Wall Street, greed is good, and it drives Wall Street, it drives finance. Greed isn't good, said SC in 2000. But don't be greedy. Don't get too greedy. But equally, don't get too scared either. You just got to. It's very difficult to manage those emotions because that's how we're built psychologically. The thing I was talking about before about the man being the leader, the pack, likes to take risk, likes to lead the family, lead the troop, lead the company. That's what drives us on as human beings, and that's how we're built. So in trading, fear and greed is what drives the markets, but you've got to be able to try and, you can't control them, but just be aware of them. Try and manage them. Take some big breaths when your heart's racing because you're watching your profit and loss ticking up and down, or ticking negative. Don't watch it. There's some way of dealing with it. If you've made your decision, you've done your analysis, you've set your target, you've set your stop loss. If your stop loss is, only a few percent of your account, so what if it goes wrong? If it goes wrong, well, that was a losing trade, never mind. Why did it lose? Well, if you've written it all down, you'll know why. You'll also know why you took the trade in the first place. And then you can analyse all that afterwards. And that's part of being a good trader as well. So, trading, deciding when to trade can be easy, I've put on there. And for me personally, this is only my own personal view. I know a lot of you out there are scalpers, but for me, the longer time frames for me means less emotion. Less emotion means better decisions for me. Okay. Um, and again, there's lots and lots of robots out there. There's lots of algos that can trade for you. I'm not a great fan of them. I've never come across one that's successful over any period of time. They can be successful in certain markets for typically a few months, but over time they tend not to be. And I'm sure things will change as years go on. But at the moment, it's all about people and people making decisions, and people are driven by fear and greed because we're psychological beasts. And if you understand that, you'll get off the first base and can move forward as a trader. So, risk management, number 3, absolutely vital. These are all old cliches that are up on there. Scared money never wins. It's absolutely true. So don't risk money you can't afford to lose. Trade with what you can afford to lose. Don't borrow money to trade. Don't put it on your credit card. Use money that you can afford to lose, and because it takes that pressure away from you. Don't put too much pressure on you at the beginning. I keep saying this: patience, discipline, control. Patience to wait for your levels, indicators, and candles to close. Again, I see many traders saying, I trade off the 1 hour candle, but when he's shown me how he's traded, he's instead of waiting for the 60 minutes to come up, he's jumped in after 32 minutes or 45 minutes or 20 minutes sometimes. And I say to people, well, you're supposed to wait till the candle. Yes, but look at it, it was really strong. And you know what happens, don't you? That candle at the end of the 60 minutes is, looks very different to it does after 30 minutes sometimes. So you've got to have patience. You've got to have discipline to stick to your plan, especially when you get a run of losing trades. But equally, when you get a run of winning trades, they are both the same emotions. Don't try and mix them up. Just because you feel good when you're winning and you feel a bit sad or down when you're losing, they are both, it's the same emotion, and they can play tricks with your mind in the same way. So a successful trader that's, you've had 5 or 6 winning trades in a row, or 6 out of 7 trades winning, you think you're on top of the world, you're great, this is easy business, and then the market comes round and teaches you a lesson. Or you get 2 down because you've had 3 or 4 losing trades in a row. You think, I can't do this anymore, I'll give up and walk away. You've got to try and take the emotion out of it and treat both those things the same. Discipline, stick to your plan, and if it isn't working, try again. But by risking a small amount, you stay in business longer to actually give your plan a chance of working. Because again, like I said before, lots of people give up too early because they've risked too much, because they've emptied their account and they've only made 5 or 6 trades when they might have had a winning system. And if they'd risked like 1 or 2% on each trade, they would have kept in the business a bit longer, got some real experience with real money in real markets, and then help them move forward from there. So patience, discipline, and control. Control of your emotions, particularly fear and greed, even hope and desire. So how do we do this? How do we become patient and disciplined and control? Well, taking the fear away, or the stress, or the pounding heart when your trades are open, or the short breathing, is because if and when you lose, the amount you lose, if you're comfortable with it, takes all that away. So I call it my 1% rule. Many people say to me, you're not going to make any money with 1%. Well, let me show you how you can. It's very simple. Okay? Or, a fixed money amount. Are you comfortable, losing $50, $5, $500, $5,000? You decide. I can't decide for you. But, the 1% rule works really well. Okay? Let me just have a look. Let's run through the 1% rule. Okay, this is very straightforward. It's very simple, basic maths, and I'll go through it quite slowly. So let's assume you've got a $5,000 account. If you stick to the 1% rule, that means every time you got a trade wrong, you will lose $50. Yes, 50 out of 5,000 is 1%. I hope everybody follows that. Let's assume you make 2 trades a day, 10 trades a week, 40 trades a month, 480 trades a year in this example. Okay, straightforward so far, hopefully. Let's assume we win 6 out of 10 trades, so we have a win rate of 60%. So every time we win, we win every 10 trades we do, we win 6 of them. You know, there might be the first 6 and then we lose 4 or 2 and 2, but let's assume we win 60%. These are just numbers that we can play with, and you can see how these numbers are. You need to understand these and how they help you. Risk-reward ratio. A lot is talked about risk-reward ratio, but for this instance, I'm going to say if we lose 1%, we want to win, in this example, 1.5%. So if we're happy to lose $50, we want to win 1.5% or $75. So every time we win, the 6 trades we win $75. So therefore, the 4 trades we lose $50, and that's what this simple maths comes up with here. So everybody hopefully should follow this. So when we win 6 times out of 10. Over the year we said we make 480 trades and we win $75. So for our winning trades we win 21,600. Yep, hopefully again nice and simple. Converse of that, we lose 4 out of 10, 480 trades, and we lose 1%. We only lose $50. So we lose 9,600. So this is when it starts to get interesting. Okay, we keep these things very simple. So when I went to school, 21,000 less 9,600 gives us a profit of 12,000 at the end of the year. 12,000 at the end of the year is equivalent to 1,000 a month. If we started with our capital of 5,000 and we were making 1,000 a month, that works out at 20% a month, or 240% return at the end of the year. So we've more than doubled our money, tripled our money. You know, we start with 5, we make 12, we end up with 17. Okay, that's assuming we win 6 out of 10 and we're happy to, you know, get a 150% hit rate, risk-reward ratio. Okay. Let's say we're not as good as that. Let's say, as I said at the beginning, let's say we only get 5 out of 10 right. So every 2 trades we do, we only win 1. You know, win 1, lose 1, win 1, lose 1, and we don't win 75. We only win 1.2. Our ratio is 1.2, or $60 instead of $50. Even then, so we get things wrong half the time. We're not winning much more than we're risking. We still, you know, make 50% of our account at the end of the year. So our 5,000 is 6,000 at the end of the year. Sorry, 7,000. So we're still making 4% a month. Again, just do the simple maths, you'll see how it works out. And that's how simple it is. Does everybody follow that? Does everybody accept what I've just put up on the screen? Is there any questions at this point? Or very quiet? I don't know. Is that good or bad? Okay, let me just bring up that little spreadsheet that helps you, and I'll bring it up, the live one, in a minute. But the problem is this: so many people can't stick to this top row here. Let me go through this a bit more slowly. This confuses people sometimes, and I'll bring up the live spreadsheet on the Excel as well in a minute. So this example is a little bit different because we've got it's assuming 520, but you'll see the numbers are very similar. So here, every time we take a trade, we're only going to risk 1%. We want to win 1.5%. Okay, that's that 1.5. So that's our 50 and our 75 and our $5,000 account. Okay, if we do 10 trades a week, here we've done it just by the weekly, so we've got 520 instead of 480. So our success ratio, our win ratio here is 60% again. So we win 300, we lose 200, but you know that 240%, 260% on this one because we've done more trades. Like the previous one was 240%. Okay, so again, even if, like the previous example, so even if we drop the profit per trade to 1.2, we only win half, we're still making our money. Well, that's a bad example, but that's still 60%. But you can see if we have a 60% win rate and have a profit per trade of 1 to 2, or risk reward ratio of 1 to 2, so we risk 50 to win 100. You know, many people talk about 1 to 3, don't they? Many trading books and trading webinars and stuff, video you see on the internet, they talk about a 1 to 3 ratio. Just look how good you would be. Look here, this is only 1 to 2, and you're still only winning 60%. You can make 400%. And again, if you keep it good, your win rate goes up to 70%. Your profit per trade is even less on this one, but you're still winning that 400% level. So it's all about the win ratio, but also the profit per trade, the risk reward ratio as well. So it's all about those numbers. It's not necessarily about the pips you're winning, it's all about the ratios, and it's all about percentages. And again, the percentages are all dependent, so concentrate on the percentages rather than the actual dollar amount. Okay, it can focus the mind much more clearly. The problem is most traders end up in this end of the chart, of the graph. They might try and risk 10% crazily to try and win 5%, and they very, very quickly end up emptying their account. Or they'll risk 5% to win 3%, or even if you flip those numbers around, risking 5% to try and win 10%, they don't win enough and they end up still with an empty account. Okay, so that's how straightforward it is. It's all about ratios, and it's all about really knowing yourself. So if I just bring this in for a minute, this is where I am. Okay, or our trades, not me, but well, it is me. But on our analysis page, we stick to this. We've had this sort of return, 2.2% over the year, and we have a return at the moment of 69%. Okay, so if you can get that sort of profit per trade, get your win rates up to 60%, 60 to 70%, these are the sort of returns you can be making, risking a very small amount. And it's all about the risk reward. It's all about risk management, keeping that risk small, and you can be successful. And it's as simple as that. The problem is people overcomplicate this business. They, go for the big winners, or they'll close winning trades when they're only, in a few dollars in or a few cents up, but they will let their losing trades get bigger and bigger and bigger because they use hope that it will going to come back. They haven't got a stop loss. Stop loss takes that away from you, and if your stop loss means you only lose 1%, like we've got here, you stay in business. The longer you stay in business, the more experience you get. The more experience you get, the more confident you get. The more confident you get, the more competent you become. And honestly, it's as simple as that, because the markets haven't changed over the last 100 and odd years. They go up, they go down, they go sideways. The most important thing is knowing yourself. If you don't know yourself, the market will take your money off you. The market is ruthless. It doesn't care about you. It does what it does. You've got to manage your risk. Okay? I sound like a preacher now. Into my end of my sermon. Okay, so hopefully that was useful for everybody. Any questions at all? It's all gone very quiet out there today. I normally get lots of questions, but does everybody understand that spreadsheet? Scary, Joel's right. It's not scary, Joel. It's simple, But you've got to understand those numbers before you take another trade. Write those numbers down. Look at your leverage. Look at your lot size. Look at why you lost. Look at why you won, and treat them both the same. Don't think, oh, I've won and don't write it down and forget about it, or I've lost, or never mind. Analyze it all. Get a trading journal if you haven't got one. Right, you've got to have a trading plan as well. And honestly, it really is that simple. If you can make it that simple, and then that takes all that stress away. That's why well, Arish quite correctly has wrote here, what if your success rate is only 40%? Well, you will end up that will be a losing trade. You need to win more than that's you need to look at your position and your trading style and your system if it's only 40%, Ashraf. But it's a start. Practice. That's what demo accounts for as well. Practice your system. Look at what approaches you and why are you only getting that sort of win rate. Is it you? Is it your system? Is it the time you're trading? Is it the information you've got? Are you trying to trade too short a time frame and you're getting whipped out? Are you trading around news and all that sort of thing? So write it all down. Isaac's written here, I made all the mistakes, had a plan, worked well till I started trading. Wrong time, which does not fit my personality, and I have lost almost all my account. Isaac, thank you for sharing that with us. Just the fact that you've written that down, means that you've accepted it. Okay, because many people won't do that. They'll tell you about their winning trades, but they won't tell you about their losing trades. That's why when we put our posts up on the analysis page, I always put up, I always say about the losing trades as well as the winning trades. We show the real win, because this business is all about managing risk and accepting losing. So Isaac, if you want to email me directly, want some more info, I'm happy to speak to you directly if you'd like to do that. But you've got to fit. I did all that as well, Isaac. When I first started, I thought I was great because I got quite lucky. But it wasn't until probably 6 months or really probably a year later I realized it was just luck. The market was going up and I was buying. It was as simple as that. I didn't do anything about it. I didn't, and that was just lucky, and that's what happened. But I say it took me 6 months to a year later before I realised that had just happened. I then tried to trade with data that was out of date on intraday trades and lost a lot of money as well. But again, it wasn't until a few months after that did I really actually realise what was going on. Yeah, send it to webinars@forex.com, Isaac, and we can have a chat if you like. Okay. So, any other questions from anybody before we call it a day? Because I've been talking long enough. What's your opinion on trailing stop loss? I don't use it personally, but I know many successful traders that do. The only problem with trailing stop losses is sometimes it can get too close to the price action, and when markets are volatile, which there certainly can be with forex, you can end up getting stopped out quite quickly. So that's the only reason I've never really used trailing stops, Joel, but many people do. Okay, these are our next webinars. Tomorrow, Kay will probably talk about a lot of what I've talked about today. We're talking about emotion control. I'm going to do a live analysis every Tuesday this month. See what sort of attendance we get. See how much people are interested in it. So a live analysis every Tuesday during March. Next Wednesday, I'm going to be talking about intraday price action strategy. I know many of you trade intraday, and I'll be looking at some intraday actions. The following Wednesday, I'll be looking at some alternative indicators, some that get overlooked. Again, Joel's talking about two of the most important things, support and resistance. Bollinger Bands, advanced trading strategies, and some fundamental analysis at the end of the month, and managing the news. And again, Kay is going to be talking about the benefits of a trading journal, which are very, very straightforward, and just do it, basically, write them down. So that's how we've got a lot of webinars this month, so hopefully you can get along to a few of them. If I've got no more questions, I will call it a day. If you've got obviously a smartphone, most of us have now these days, make sure you download our app, because it's very, very useful. It's got the prices on there, it's got our analysis on there, it's got the news on there as well, so it's it's great. I always look at it first thing in the morning, see what's been going on overnight. Blessings asked here, is there any number of pips you suggest is a safe to hold on during a loss? Blessing, it's not about pips, it's about amount of if a loss gets to, as I say, if a loss gets to 1% of your account, that's where you should close it, and therefore you should work out your lot size based on if you're doing it money wise, your lot size should be means that if that price got to that stop loss, it's only 1% of your account, so you need to adjust your lot size accordingly, adjust your risk accordingly. So for instance, when there's many trades come up all at once, which can happen when you're trading forex, because a currency tends to move against all its other currencies in the same way. So for instance, if the Aussie dollar suddenly got weak like it did overnight this morning after some good news, it could trigger lots of options on lots of Aussie crosses, so you've got to decide whether you take them all, and if you do that, you just then reduce your risk on each of those trades, but make sure you're not overexposed in total. Okay, So 1% per trade, you know, a maximum of 5% at any one time. So if all 5 trades went wrong, you'd only ever lose 5%. That's another little idea I try to stick to as well. Okay, so if there's no more questions, I'll call it a day today. A lot of you have been here today. These slides will be up on, and the recording will be up with you shortly. Andrew, it'll be up on the website in the next hour or two. These are my, you know, I've got lots of trading books. These are the ones I talk about the most. The most important one here is The Reminiscences of a Stock Operator. I haven't got time to talk about that today, but great book. If you're new, Anna Cooling's Forex for Beginners is another great book. You can have that as an ebook. You can download it as an ebook and get a hard copy from Amazon.com as well. And there we go. So again, these are just some thoughts of Jesse Livermore, but I haven't got time to talk about those today. But thank you for your time today. I hope it's been useful. You can apply these numbers. And if anybody wants a copy of that spreadsheet that we saw on the slides, please email us at webinars@hotforex.com and I can send you a copy of the spreadsheet and you can play with it yourself. See those mess around with those percentages, those win rates, the success ratios, and you know, see how it is all in those very, very simple numbers. Okay, all the very best. Thank you for your time today, and I'll see you again next Tuesday. Okay, take care. Bye bye.